This headline makes it sound like another billionaire just buying Bitcoin, but it's not. What matters here isn't the Bitcoin, it's the structure behind it. Grant Cardone says he plans to launch a publicly traded Bitcoin Treasury company in 2026, not funded by debt, not funded by leverage, but funded by US rental income. That combination, guys, has never existed in a public Bitcoin treasury, and it matters. If this plan moves forward, it would be the first publicly listed Bitcoin treasury backed by cash flowing real estate. That changes how institutions think about Bitcoin exposure. It changes how balance sheets can accumulate Bitcoin without leverage risk. And there's one detail in how Cardone is structuring this that could quietly influence how future Bitcoin treasury companies are built. But we'll get to that in a moment. Here is what we know right now about this story. In a recent interview, Grant Cardone confirmed plans to launch a public company in 2026 designed to hold what he described as the world's largest corporate Bitcoin treasury. The funding source is the critical distinction, though. He's not issuing debt, no convertible notes, no financial engineering. Instead, Bitcoin accumulation would be funded by rental income generated from Cardone Capital, a firm that manages roughly $5.5 billion in US multifamily real estate. Cardone also confirmed the balance sheet already holds approximately $300 million worth of Bitcoin, with plans to acquire more next year. This isn't just about Cardone buying Bitcoin. It's about how he's actually doing it. Because unlike Michael Saylor and MicroStrategy's approach, where leverage amplified both returns and risk, Cardone's model attempts to turn Bitcoin into a cash flow funded reserve asset. That distinction matters far more than the headlines suggest. And here's why institutions are paying attention to this. At face value, Cardone's announcement doesn't move Bitcoin's price today, but structurally, it signals something much more important. Bitcoin accumulation without capital markets dependence, treasury growth decoupled from debt cycles, a model institutions can justify to internal risk committees. That's a very different conversation than Bitcoin speculation. Because this would be a public company. The Bitcoin exposure would become audited, disclosed, and governed by securities law. And that matters to the big boys, right? It reframes Bitcoin from a speculative asset into a long duration balance sheet allocation, funded by predictable cash flows rather than financial leverage. Guys, he's using income generated from real estate, from real assets to buy the Bitcoin, not giving out leveraged loans to buy the Bitcoin on interest like Michael Saylor's strategy is doing. That is a huge distinction, much more safe, much more easily for big institutions to get behind. It is closer, this is much closer to how pension funds and insurers already think, just with a new asset class on the balance sheet. So Cardone's model is different, right? We said it in the beginning. Nobody's done this before. He has explicitly criticized companies that copied Michael Saylor's Bitcoin strategy without an operating business underneath it, right? He doesn't want to just buy Bitcoin and hope it goes up. He has a real business and is using profits to buy the Bitcoin. So, in a nutshell, Cardone's approach relies on rental income as a steady acquisition engine, tax advantage depreciation from the real estate, long-term Bitcoin accumulation rather than short-term price timing. In his words, it is about combining a heavy fixed asset that's not volatile and not liquid with a digital asset that is extremely liquid and volatile. And that pairing is 100% intentional. So this also isn't Cardone's first test. Earlier this year, he listed a Miami oceanfront mansion priced entirely in Bitcoin, roughly 400 Bitcoin. The property later sold. That move wasn't about marketing. It was about testing his thesis, testing Bitcoin as a treasury asset, as a unit of account, as a settlement layer for high value transactions. So here's the takeaway. Here's what we can learn from this as investors. Grant Cardone is not betting on the hype of Bitcoin. He's betting on structure. A publicly traded company, cash flow funded Bitcoin accumulation, no leverage dependence. If this IPO actually launches in 2026, it could become a template for how conservative capital gains Bitcoin exposure. It could be quiet, slow, and defensible. And guys, this isn't a price call. It's not a price call. It's not saying Bitcoin's going to a certain price. It is a signal that Bitcoin is here to stay, and the big boys are finding creative ways to leverage it. And if more operators follow in this model, the next phase of Bitcoin adoption may not come from tech. It may come from balance sheets. Guys, if you found value in this, hit like, hit subscribe to this channel, because I'm going to bring you more updates as this story develops and what it means for Bitcoin treasuries going forward. So be looking for the next report. Guys, this is Ledger Prime. Thanks for watching.